We've been talking a little bit about things that our investors had shared with us that they wish maybe they had done different. And we were talking a little bit about the psychology. I think that's important in the fact that, how people view investing, how they view themselves, and how honest are they with themselves. Because it's a different story. As you mentioned, the emotion sometimes overtakes all common sense.
Mm-hmm. Yeah, no, absolutely. I mean, we can talk all we want about, consistently investing time in the market, that sort of thing, and that's all extremely important. But at the end of the day, nothing, and we've both seen this many times, nothing will kill performance more than getting out at a bad time, trying to time the market, letting your emotions get the best of you when it comes to your investments and your retirement savings. Now, easier said than done. I completely understand, and even for me and Rob, two people in the industry, money's emotional for all of us, but to be able to combat that is very important. And I think that's kind of an instrumental part of our job. Of course, we're here to help clients invest, but probably most of our value comes from talking people off of the ledge a lot of the times. I mean, it really it's important to stay consistent, stay in, and remember your goals.
Right. I mean, we are many times we are financial planners, but sometimes we're kind of an investment psychologist, and that's what we're here for. It's the education portion of becoming successful in investing is not just being shown the investment and not just telling you, hey, the more you save, the better you'll be, but it's to understand your investment objective, and we can help you kind of make sure that investment objective is accurate for where you are in your time frame. But it's also what's your tolerance? I mean, as I mentioned before, I've got clients in their 40s who want nothing to do with the stock market. Money market returns will take care of it. And I've got clients that are in their 90s that have experienced what the stock market can do. They understand the big term numbers. As long as their income is not too big, they can keep pulling it off. And so there's no right or wrong. Everybody's unique, right. But you do need sometimes a little help, maybe a pat on the back to tell you you're doing something well, or maybe a little nudge saying, if you were to maybe make this tweak, here's how we think it would help. So the psychology part plays a bigger role than I think a lot of people give it credit for. Yeah,
no, absolutely. And there's a lot of ways that that you can make savings and investing fun. It's kind of treating savings as a game, for example. So compared to exercise, it's kind of fitting right now with Joel running the marathon. And speaking of this whole young versus old, I'm the young one, but Joel can certainly run a marathon a lot better than I can. I'm not in that kind of shape. So we will see. I'm curious to see when he comes in the office next week how well he's doing. But
how he's feeling, and if he's limping.
Yeah. I know how I would be feeling.
Yeah, I'd be moving very slow. Yep. Very slow.
But comparing savings as to exercise, for example, when you're getting into shape, you start out slow, and of course it is a marathon, and retirement would be the end. So it's important to sort of think of it that way and stay consistent.
Yeah, I think of using the exercise analogy as you got to kind of keep doing it multiple times, right? If you work out once and then you don't work out again for another month, it's really not going to do a lot for you. And if on the investing you throw some money in and then you don't put any more money in for another month, not as effective as if you consistently, once a week, once a month, put in a certain amount. And the same thing with exercise, right?
Yeah, no, absolutely. I think of it as if you work out all week and you eat right, and then you have 5,000 calories every single day on Saturday and Sunday, you can very easily throw your week's progress away. And you could look at it the same way with savings and investing, being very diligent throughout the week, and then you go and load up on a bunch of credit card debt Friday, Saturday, Sunday night, then that's not exactly pushing you towards your goals.
Correct. Yeah. So, when we think of retirement, which everybody's ultimate goal would be to get to retirement and to be in a place where you're very comfortable and your investments can then work for you into retirement. It's a race, right? You start now, you got to finish the race, you got to get through it. It is a marathon. I mean, if Joel were to go into the marathon and decide he's going to try to sprint as fast as he can to get ahead of everybody, he probably would burn out and would not be able to finish the race. And so investing is the same way. It's not sprint right now and then it's make a decision, make a budget, pay yourself, be consistent, get good investment advice on the psychology side as well as the investment side.
Yeah, and you can think of goals as well in terms of sort of a bucket system, short, mid, and long-term goals. So short would be something like maybe you are saving for a car within the next year, and you're putting money into a money market, high yield savings, something like that. Midterm goal, maybe you want to buy a house in the next 5, 6 years, 10 years, and you're putting money away towards that. And then long-term goals would be retirement accounts, things like that. Longer term, IRAs, 401ks, workplace retirement plans, that sort of thing. So good to have goals for every different period of time, and to be diligent and keep up with those.
Right, and with that bucket system, you want to make sure that you're not pulling money out of the long-term retirement earmarked funds so that you can buy the car today.
Right.
Because, great, now you got the car wears out, now it's time to do something different, then you move into retirement, and then you've invaded the funds that should have been kept for the long term. So the bucket system, and then that way, when you make it a game, it's like, hey, if this bucket gets to a certain point, then I can buy a new sofa, or I will take a trip. And the midterm is like, once I get to this point, that will cover sending my kid to college. And then my long term, I want to keep that as big as I can, because my goal is to have this much income in retirement, and so I need around this much investments to generate that income. So it's good to kind of segregate them, keep them apart.
Yeah, and then each goal is also going to have a different investment allocation, right? So a short-term goal would have, like that car example would be high yield savings, money market, cash equivalents, that sort of thing. A midterm goal, maybe we would use one of our balanced funds or something like that, part stock, part bond, a good mix of both. And then for your long-term retirement goals, you're looking at maybe more of a aggressively positioned allocation to with that long time horizon, you can certainly stomach a little bit more volatility just mathematically.
That's a good point. Your investment objective with the different buckets is going to be different. Length of time, how it's invested, how much risk can you tolerate that. So each bucket would have its own separate sort of allocation and be managed differently. That's a very good point.
Yep. Yeah, and risk tolerance is an interesting thing as well, because, of course, age is a huge determining factor in what your risk tolerance maybe should be, again, mathematically. But back to the whole, how emotional finances are, that's not always the case, and it's not always so black and white, right? I mean, we both have seen plenty of young people that have a lower risk tolerance than some of our older clients, even in retirement. So it's a very personal thing, and it's not always as easy as just, oh, you're 30, so you should be very aggressive, versus you're 75, so you should be positioned a little bit less aggressively. We may advocate for that, but at the end of the day, you have to be okay with it. You have to be comfortable with it.
Sure, and then you need to also understand your expectations. Part of the education is based on each bucket and what it's designed to do. The amount of growth it may get, the amount of volatility that it may suffer from, needs to be explained up front. You need to we manage the expectations of our clients by explaining to them, this bucket is designed to do this, and thus we think these kind of investments will do it. Here's the expected return. Here's also expectation of what you may experience along the way.
Mm-hmm. Absolutely. Yeah, so, I mean, there's been a lot of there's certainly a lot of differences, but also a lot of similarities between investing as a young person versus an old person. It's maybe your current mix is different, but your end goal is likely the same. So this has been Chet Cowart and Rob Field with Nelson Financial Planning. Visit our website, nelsonfinancialplanning.com, or give us a call if you have any questions about any of this, whether you are in your accumulation phase, saving for retirement, or you're already there. We would be happy to help you. Thank you for listening.